Hey, my friend, Dr. Barry Burns here with Top Dog Trading. Today we're going to talk about day trading strategies, specifically the mid pivots. Now, mid pivots are something that not very many people use, and I love them. I find they work really, really well. But there's a time to use them and a time not to, and I'm going to share all that with you here in just the next few minutes. So let's talk about pivots first of all. When I'm talking about pivots right now in this context, I'm not talking about what I would refer to as swing highs and swing lows. Some people call these pivots just because it made a high, low, swing high, swing low. And that's perfectly fine. And there is a context for that. But what I'm talking about today are what I call floor trader pivots, which is a formula, and it's based off of the previous day's high, low, and close. So when you're day trading especially, three of the most important levels you should always be aware of is the previous day's high, and that's right here, yesterday's high. Yesterday's close, and you can see that over here, and then yesterday's low. And the reason you need to be watching these and have these on your charts is because, well, pretty much everybody else does. So they have a self-fulfilling prophecy to them in the sense that people are looking at those levels as being major levels of value. So that's all fine. Now, the floor trader pivots is basically a formula that's based off of those three values. So it forms let me take this off first so we can focus on the pivots. It creates a pivot point. That's your central pivot. That's considered the neutral zone, the kind of the line in the sand between a bull and a bear market. Then you have your resistance levels, and they're called R1, R2, R3, and they'd be above the pivot point, or sometimes it's called central pivot. And then below that you have your support levels, and so those are S1, S2, S3. And so those are below your pivot point or your central pivot. Those are in your bearish area. Okay, now, what I do is, and that's very common, by the way, let me, no, I'll do that at the end. I was going to show you the formula. I can show you the formula at the end. So a lot of people do this, very, very common, and again, as part of the reason it works is because so many people use them. So, for example, when we look at S1, you know, the market bounced off of it here, R1, the market bounced off of it there, went back into the previous day's high, came up to it there. So yes, provides support resistance. It's not enough to trade with, but it's part of a trading methodology. Now, the other thing that I do, though, that's rather unique, and I'm certainly not the only one who does this, but not many people do it. So here we have your pivot point, and here we have your R1. What I do is I put the mid pivots in there. So as you can see, I have it labeled R1 dash pivot points. That's the 50% level. Very simple to calculate. Just 50% between the pivot point and R1. That's it. It's not brain surgery. Okay. And then same thing going down. So between the pivot point and S1, 50% level there, I've got my mid pivot. Now, very simple, and a lot of the best things in trading are simple, but I just draw extra support resistance levels. And as you can see, the market indeed, after it came off of R1, it came back up, and where did it find resistance? At that mid pivot. Boom, right there. There was no regular pivot point there, just the mid pivot. Same thing down here. We came down, went down to S1, then where did we come back up to? Well, we went to yesterday's low, and then we kind of hovered around that, but then we went back up, and where'd we go? We went to the mid pivot. So there, and by the way, as it came down from there, same thing. Where did we end up? Down to another mid pivot. This one's between S1 and S2, and we found support there. So they're good levels to have, and again, the market really does respond to them. Now, to finish up, I told you that I would tell you when to use them and when not to use them. So because pivot points are calculated on the previous day's high, low, and close, if the previous day was a narrow range day, then don't use the mid pivots. At least I don't use the mid pivots. Why? Because then your regular pivot lines will be very close together, and you'll just have too many lines and they're all close together and it just looks messy and there's really not much room for the market to move. It's normally going to move between its regular pivot levels and not the mid pivots. So the mid pivots work best when the previous day was a wide range day and you have a lot of space between the regular pivots, between pivot point R1, R2. As you can see, it even goes off of the chart here. So we'd have to go all the way up here for R2, all the way up there for R3. See how far those are apart? So to put a mid pivot there gives us some support resistance levels in that wide space. So that's it for today, and I invite you to add those to your charts, test it out, see for yourself, and see if it makes sense to you. And I think you're going to find that they provide great support resistance levels that you haven't seen before. Invisible support resistance that you'll see, and the people on the other side of your trade, they won't see it. Gives you an edge. It gives you an advantage. So if you like this video, please click the like button below and leave a comment telling me what you'd like me to cover in future videos. Also, I'm giving away one of my favorite trade strategies right now called the rubber band trade, which has an extremely high win-loss ratio. It's a simple strategy. You can learn it in about 26 minutes. So get the video explaining that trade strategy absolutely free by clicking on the image in the top left corner, or if you're on a mobile device, click on the little eye with a circle around it in the top right-hand corner of this video. And once you do that, I'll personally email the video to you.